But when you get closer to that lunch hour, and usually around 10:50 to 10:10, in that area, there's a lunch macro. Okay, 10:50 to 11:10. I want you to annotate this on your charts every day. Study what price is doing. Oh, well, don't do that. Okay, annotate your chart like that, and just, I guess, record it and annotate it in a way where you know what you're referencing there. New York lunch macro. In your notes, it'd be better if you had your annotation visible, right? And you want to study when the market's consolidating. Okay, you're going to get that price run between 10:50 and 11:10. What that does is it's kind of like the last ditch before. Yes, traders do take lunch. Okay, they absolutely do take lunch. The algorithm doesn't take lunch, but it likes to stimulate the volume and sentiment going into that lunch hour. Because lunch hour can be a pause and continuation of a trending day, or it can be a reversal, or it could just stay sideways and do nothing and chop. Here's the wonderful thing about this 10:50 till 11:10. It doesn't matter which one of those conditions are there. You're going to see a move form between 10:50 and 11:10. And what is likely to occur is where hasn't that liquidity been tapped into yet? And that's what I was walking you through here. We've already seen sell side taken. Where's buy side? Here. And where I've outlined it here. And if it goes to that level, it's going to expand up into that area here. Now, if it was taken out that low, here I mentioned that we would look for it to go here. We didn't take the low out. We took a market shift bullish here. I told you to watch this one here. Even if it just trades in there, that's where you enter. It's called close proximity entries. You don't need a breaker. Okay, you don't need a breaker to trade above and come back down and touch it. You can do that. That's how I taught it. But I don't require just that. If I know where I'm likely to see price go to, buy side and buy side between 10:50 and 11:10, you're going to see a price run that's originating then. It will happen regardless if there's a consolidation day, a reversal day, or is a trend continuation after lunch. It doesn't matter. You're going to see a price run begin at that. It's a small little segment of price action and time, and it's going to run for liquidity. It's going to run for the liquidity that has not been tapped yet, and that's what you're seeing here. Okay, the levels inside the consolidation between 951 and 1028. While they're in there, everything is going to be conflicting. But once you get to 10:50 to 11:10, that lunch macro, and you've seen me do executions of this on my Twitter feed, it's based on this logic. You have to look for where hasn't it been tapped into yet? What hasn't been affected? Who hasn't been upset? Where's the pain threshold for the people that feel the safest? Well, anyone with a stop above this high felt safest, especially when it dropped from here. And when it went down lower than that low there, and then it created a short-term high, traded back down in, and then rally after that fair value gap. Once it ripped higher above here, that is a shift in market structure during a specific time of day, 10:50 to 11:10. That's algorithmic. It has nothing to do with harmonic patterns. It has nothing to do with Elliott wave, nothing supply and demand. It's absolutely internally built. It's part of it. It's codified. It's code. It's there. It will run for liquidity that has not been tapped. Now, this many times can be a key point for the day, and it never returns back down below it or above it in reference to if it was going lower. I'm not teaching it for you to have that understanding alone. It's for you to study how to, if you're watching these consolidation days like this, study between 10.50 and 11.10 and see if you don't get a price run like this. Don't take my word for it. Go back and through charts and go forward with it. We've seen how they, excuse me, they opened it and worked that old low multiple times, inducing new shorts to chase it going lower. I mentioned this level down here. That's a fulcrum point. It has to go below that low. If it goes below that low, then you can see lower prices, but it didn't go lower than that. We had sell side taken. This right here, this returned back down in. Sorry. Into that fair value gap right here. That price run to here. This is your last like bus stop before you get to your destination. If you don't get on that bus, you ain't getting on it. That's why I said watch this one here. As soon as it traded into it, or into this candle here, as close as you can get inside that volume imbalance. That's it. Now watch what happens. I'm going to look in this small little segment of price action right here. Okay. Actually, I moved it wrong. Sorry. I can make sure I do it right. Okay. And inside this little area, I'm going to change the color to yellow. It stands out. It's not perfect, but it's enough to get our attention. So I'm going to drop down into a 15-second chart. What do you see? I'm not going to say it, but what do you see? Two down closed candles. High, low, fair value gap, order block, inside the volume imbalance. It trades down to it, and then boom. That's your lunch macro right there, using the 15-second chart. So when you see me doing these big run-ups and I'm building and building and building, I may be recording the 1-minute chart, but you're not seeing me using all the other charts in front of me. Then I'm looking at that. That right there is my hammer. Okay, and when I swing that, it gives those big nice price runs. So don't run away from this lesson thinking I'm beating my chest, look how smart I am, because I was showing you, even in these conditions, it's difficult for me as well. And how you need to identify what it's likely to do to you as a trader. How did it feel for you today watching price action? Were you frustrated? Were you anxious? Were you second guessing? Were you thinking that they changed the algorithm? They're not changing shit. Okay? The bottom line is it's going to stay like this. It's going to continuously do this. But the markets are going to do one of three things, okay? It's going to consolidate, or it's going to go higher, or it's going to go lower. That's it. That's the only things that can happen, or they don't trade that day because of a holiday. So those things are pretty straightforward. And unless you can frame the outcome to the market's likely to go higher to this level, this is my magnet and price, this draw on liquidity, this is where the market's going to reach to. If you can't clearly see that in your analysis, you are gambling. And I don't care what methodology you use or who taught you, and it doesn't matter. Unless you know where it's likely to go to, there's no way you can be consistent. None. Zero. Because every logic, even mine, if it's forced into the wrong conditions where the market's not going to move, even it will fail. All my PDA arrays will fail if the market's not going anywhere. You have to have the most important element. Time. Time. Nothing is going to happen in price action until it reaches a specific time of day. a day of week, a week of the month of the year, seasonality. All those factors come together and they agree, like pins in a tumbler. You know, the lock turns. Everything comes together perfectly when it's all those other factors. But you just can't frame the whole trade idea on the basis of a simple order block or a fair value gap. There has to be other things. And you can see when you're met with additional difficulty, it's next to impossible to feel confident. But when time enters the equation in the chat, things change. Okay, things change, things become a little bit more clear, and it's like this in the last hour of trading too. There's 3 macros that run in that last 3 hours. That last hour of trading between 3 o'clock and 4 o'clock. There's 3 specific macros. Not every day does all 3 of them occur. Usually 2, but always one of them.